And so my name's Alex McDougall. I'm the Chief Investment Officer for a venture capital fund called Bicameral Ventures based out of Toronto. So it's a venture fund that runs based entirely on crypto. So we raise money in crypto, we invest directly in crypto, we pay ourselves in crypto, we pay our lawyers in crypto, we take our marketing or our management fees in crypto. Our benchmark is based on crypto. So we're really extending out the use case of crypto all the way from start to finish. A little bit about my background. I'm a former investment banker. I worked for many years with the Bank of Montreal in Toronto on the M&A side, and then moved to sort of the fintech side and saw the evolution of Bank of Montreal, or evolution of sort of crypto and fintech in general, just getting farther and farther away from what big institutions were ready and prepared and able to actually do. And so I left about 6 months ago to start Bicameral Ventures with my partner, who's one of the co-founders of the Aeon technology, which you've heard in several pitches featured already. And so we run our fund on the actual Aeon coin from start to finish. And so it's a very interesting, unique take on an ecosystem fund. And so when we think bicameral, bicameral actually means something that's influenced by two chambers of thought. And so the way we invest, there's always the obvious chamber of thought, the team, the market, the business model, the profit, the actual kind of the investment case. But there's always something else that goes along with a project. And whether it's where it fits into an ecosystem, whether it's where it fits into the sequencing of some trend in history, what are the situations or what are the circumstances that allowed this project to evolve? If this project happens, what does that mean for the next project that's after that? There's always some second chamber of thought that goes with it. So the way we think about investing is there's always sort of the standalone case, and then there's the other case, the other aspect to it. And we really try and focus on that. And so what I want to walk you guys through today is one of our kind of long-standing chambers of thought, what we call the archetype of one. And so it's sorry, there we go. So humans are amazing, wonderful, interesting creatures. Forever and ever and ever, if you give us a set of circumstances and you give us a set of restrictions, we'll be able to maximize within that actual set of circumstances. Individually, we're panicky and stupid, but on a mass level, we generally get to where we're going in the end. And so we started out with small communities and small offline commerce. So you trade with the person beside you because that was the person beside you. Because you had large frictions and opportunity costs inherent in going down the road. You could walk, there could be a guy in a tribe 3 over, but it would take you 3 days to walk there. So you'll trade even if it's not quite profit maximizing with the person right beside you. So as technology expanded, as we got horses, cars, planes, trains, automobiles, our ability to do commerce on a meaningful basis expanded outwards as those frictions reduced, and we were able to interact and communicate with more people. And finally, we got to World Wide Web, email, fax, telephones, all of that stuff, to the point where today we really don't have any actual physical global frictions that are disincentivizing or not enabling global commerce. But as we started to chunk everything out, what became apparent and what sort of was always in the background but was always dominated by these physical frictions was the trust friction. So you know the people in your immediate tribe, or just like Chema Pesa was talking about before, you're willing to lend within your immediate tribe and your immediate crew of people that you work with. But you work one step out and 2 steps out and 3 steps out, and that gets more and more and more diluted, to the point where when the opportunity cost of frictions dilutes and the opportunity cost of frictions reduces, the only thing that's left in inhibiting us from a real global commerce today is this trust friction that's left. And so what does that do? So in the early days, as you mentioned, you trade with the people who are right beside you. You trade in your immediate area. It's not super profitable, but it's safe. And so these physical frictions are things that you can game plan for. If you know it costs $100 to drive down the street, that's fine. You put that in your operating model and everything's great. But once you start outsourcing, or once you start going bigger than your immediate people around you, you start running into these, and expanding into new markets, you start running into these capital events. So which are either bad actors, so somebody who doesn't pay you, or just as importantly, bad products. If you're making a red scarf for a tribe 3 over where red is an unlucky number, the total loss that's inherent in a bad product is just as big as what's inherent in a bad actor. And so there's these capital losses that individual entrepreneurs aren't set up to handle. So whether it's a bad actor or a bad product, the construct of a capital loss keeps you to a sphere of people you're willing to transact with, where you can be a certain level of trusting that you won't experience those capital losses. So the rational outlook of it is essentially somebody comes along and says, don't worry about if somebody doesn't pay you, I'll make you whole, and you pay me 10% of every transaction. And so you end up with these risk pooling agents who essentially take all of your capital risk and turn it into operational risks. And individual entrepreneurs can deal with operational risks. And that's essentially the model that we've had for hundreds and hundreds of years of these rational, centralized trust proxiers. So what are these centralized trust proxiers actually doing? Because they're rational as well. So on the back end, they need to make money. So they're not just blindly trusting everybody. In the early days, it was a web of people. So you'd have the Medici family of banking, where you'd have a brother in Madrid and a brother in New York, and they'd each know people, and you'd say, cool, all right, you know that guy, I know that guy, great, let's do this. But that's not really scalable. So, or you'd have an international fashion house where you'd have a aunt in Paris or somebody somewhere else that knows the market and you'd be willing to trust their interpretation of the market. So you take your bad product risk down by several amounts. But it's not scalable. If somebody knows somebody in New York and somebody knows somebody in Chicago, they don't always know another person there. So this web of actual relationships was wonderful, and it made commerce work for years and years and years and years and years. But it has its limits. And so people started moving towards this other web on the other side. And it's a web of archetypes, where it's not the individual person you know, it's the profile of that person. And the profile of that person driven on data. So they started out very, very, very simple. So people in Canada are like this, people in the UK are like that. And then got more and more granular and more sophisticated as the level of data that informed these decisions got better and better and better. To the point where we're kind of at that situation today where we can have very, very good archetypes, but whereas the centralized web of relationships was big banking families, big fashion houses, big advertising agencies, we end up with the centralized web of these archetypes, which is the companies that are harvesting and creating the most data, the Googles, the Facebooks of the world. So it's an evolution of this rational centralization that has just evolved from a web of interpersonal relationships to a web of understanding of archetypes. And this is what we rely on now to have trust in not an individual person anymore, but in a profile of that person. People who are like this will default on their loans X% of the time. People who are like this prefer to drive this route to work. People who are like this prefer to XYZ. And it's a match of both the bad actor and bad products. And that's essentially where we are today. Man, I cannot get this right. We'll nail it down eventually, guys. So where we really want to get to, and this is the Platonic ideal, and this I think we're actually rapidly moving towards, but there's major issues still in getting there, is to break down that person at the top while moving that data collection forward to the point where we get to what we call the archetype of one, where there's a perfect digital representation of you that is actually completely absent of you as the human being, but everything that you've done, your profile, your preferences, your abilities, all of that stuff can be referenced if you want it to be, to enable you to transact like you used to with the people beside you in the real world in a digital world. And that really eliminates that last barrier of the trust friction and allows you to interact with people on a global scale on a trusted way like we used to interact with people in the real world while maintaining the anonymity. Now, there's still many, many shortcomings and many, many things that we need to get to. First and foremost, as was brought up earlier, the privacy angle of putting things on chain and putting more data out there without the appropriate filters or without GDPR compliance is a huge challenge. But this is kind of the Platonic ideal in my view. Almost got it. I'm like 90% there, guys, I swear. So this ends up on this trust versus capital scale, where there's a bigger gap in trust, more capital is required. If you trust the other person not at all, you need to bookmark enough capital against that relationship to be able to sustain a total loss. If you trust them a little bit, you can put a little bit less capital. If you have a model that says for an insurance company, this person is going to get into accidents X% of times, but you don't trust that model very much, or if you have an untrusted model, you need to put more capital against that. If you have a supply chain where you don't know if something breaks down, it takes you 45 days to figure out who was at fault, you need to put a huge amount of capital against that. If you can figure out exactly immediately what was at fault through great data and be able to go directly to the companies and recover, you can put much less capital against that. And so we end up somewhere on this this trust versus capital scale, where when you have less trust, the amount of capital you need is higher, the amount of price you need to charge is higher as capital is expensive, and you end up with this sort of artificially large commerce, where it should be able to be a lot more small and a lot more unitary. So this is where we start to figure out from an investing perspective where we're interested. And it's moving this needle along the trust versus capital scale. So when you can create more data, better data, or have more trust in the data that you have, you can meaningfully move the needle on this scale. So there's fintech companies that are doing great jobs of it already. Clearbank is a great example of one. They're a tech-enabled bank out of Canada that just raised $70 million, and essentially they use data collected from the sharing economy, Airbnb, Facebook ad revenue, in order to lend against, in a way that traditional banks are completely unwilling to do. So by creating more data and creating a new archetype that they understand better, they've created an entirely new niche in this economy that's marketable to them. A bank might have either not lend to them at all, or lent at 35% or something along those lines, but most banks probably wouldn't do that. And they came up with a new model based on new data that they created an entirely new archetype around. There's one of the projects earlier today, Lendvio. I'll get the name right in the end there. Enables you to look at factoring invoices and prove that they're correct, and enable you to essentially go a level deeper on trusting the data that you had. Because banks forever have looked at your invoices and have looked at your sales and said, okay, well, I'd trust that lending profile to a certain extent, but they have no idea if there's fraud behind that. But they've factored that into their model. They say, okay, well, it's an X% risk of loss, and so we'll go from that. If you can provably trust that those invoices are real, you take your X% and you cut it in half, and you're allowed to put less capital against it. It costs less, and you can generally factor and scale down commerce incrementally. And when you can release capital from the entire value scale, you create real value that can be redistributed across that entire value chain. So blockchain is really where this takes the next step, and we're missing it at the bottom there. So with essentially the ability to, when data is hashed to a chain, trust it absolutely, is a huge game changer in terms of being able to feed the right data into your model and interesting data into your model and trust the results of your model that much more implicitly. Incented real-time data. Currently the model essentially is Google says, here's a free search engine, now give me every single piece of data you create. Or Facebook does the exact same thing. And it's these huge, big bulk trades of your everything for one platform. And that's really the only model that exists today. Now, they're obviously incented to do that. You could probably make it more granular with the current fiat model. But the ability to have these oracles and real-time data that's generated and trusted, and then have decentralized logic immediately pay individuals at that exact time to give you the right data on time, in real time, and from the exact people that you're trying to target because they have the profile, is incredibly valuable. And that's something the blockchain enables as well. And the last is really this flip from the centralized web of archetypes to this decentralized web of the archetype of one, where you are the owner of your data and you have the self-sovereignty of your data. And so this entire profile of you accrues to you. It's not Google selling a profile of you onto somebody, but you being the actual actor and an actor of your own data. And all of those enable such a shift along this value chain that it's really cool to see kind of in real time. So fintech started it, and blockchain is really moving that needle incrementally. The second is sort of the flip side on this scale of even if you can't acquire data or you can't acquire trust in another party, you can actually trust a transaction implicitly without data. And this was the original point of blockchain in the first place, was the trustless transaction. I could be transacting with somebody I've never met, know absolutely nothing about, but because of the transaction itself and the cryptography behind it, I can implicitly trust that actual transaction. And so a lot of people saw blockchain do that and stopped there and said, okay, well, it's a trustless world. We no longer need to know anything about anybody. And that's not really the right thing, because you can't create products, you can't learn people's habits, you can't learn behaviors, all of that. So it's a mix of these two things. But the ability, so 0x, Augur, and kind of digital goods, and there's a bunch of projects that have pitched today as well, about the ability to have something happen and have the result to be automatic, decentrally justifiable, and not have to rely on actual trust in the other party is a huge game changer. So our oyster playground world that we say is the intersection of those two. So projects that are actually doing both of those. That's where we create real value, and that's where we really see the actual value of all of these projects coming together, is when you can create a better model of somebody and also rely less on that data to actually trust them. You can almost get down to zero actual trust risk. There's always this orange bar at the bottom, which is earthquakes, mechanical failures, things that are actual just risks of the real business model. And so the way we think about it is Aeon essentially is enabling you to not have silos of blockchain data, like we have silos of data right now. But if you're in an Ethereum, EOS, NEM individual world, you're going to have data accrue on each of them, and you're going to have to pull yourself out and pull yourself into another one. And Aeon essentially creates decentralized bridges that weave all of these blockchains together and allow these real world complicated business models to have a brain on one chain and reach out into a bunch of other chains to execute really kind of tailored niche decentralized logic. So we've seen a few of these guys present today. WinMiner Trustlessly essentially creates the fabric that allows you to have that trust in the underlying core project or the underlying core blockchain by decentralizing the proof of work mechanics. Velocia trustlessly incents the actual mobility data of their users to be shared with people who really value it in a one-to-one, non-centralized intermediary way. And we have two other fantastic projects as well that happy to talk about offline. And I wanted to actually go through a couple of the lessons that we learned today from some of the projects that we're pitching. We talked about Velocia and WinMiner. InView, and I mentioned them earlier, is leveraging the blockchain and a trusted platform to increase that trust in lending profiles. Same data, but a deeper level of trust, which again allows you to make your model better and make your actual capital requirements lower. Adezi is peer-based trust. So if your friend likes an ad, it's more likely now that you're going to like that ad. And those peers, by being linked to each other, increase that sort of trust that in your individual profile. Cement DAO. Prediction markets, as mentioned, humans, when they're en masse, are often more likely to get to the right results. There's challenges in prediction markets as well when you're trying to incent different things. But in general, when you can have, and same with Lending Club, when you can have multiple eyes on the same piece of data and come to one consensus version of whether that data is right, what that data means, what that lending profile means, you're more likely to get it right than one individual company or one individual underwriter looking at that piece of data. And finally, Shamapesa, I thought it was a perfect kind of analogy for this whole thing that we're doing now, which is the offline versus online trust. And people bond together in real world communities in order because they trust each other, because they know each other from the social club, because they know each other from the village. And this is a way to digitize that trust and by definition scale it, and scale it out of the usual constraints that they've been based in. So what do you as an entrepreneur kind of take away from all of this? The first thing I'd encourage you is think through how you're creating value in this model. And we say it implicitly or explicitly all the time. We actually walk through how this works for all of our projects. But everybody thinks about this to a certain extent of how are you improving the world, how are you actually creating value. And if you can articulate your value proposition in something approximating these terms, it's a pretty well resonating point. You can create new profitable niches and steal business from big established players just by understanding the same data set in a better, more unique way. Think about how to acquire more data for less, how to trust existing data better, and how to actually operate in a completely trustless world, even if you don't have data on the other side. How to craft a value proposition for somebody who already has a stash of data. And this is a fascinating one that Velocia tackles. That's right, Greg. Yeah. Velocia tackles, and everybody who's ending up dealing with insurance companies or something along those lines, where they're already in their moat. They have their stash of data, and they're jealously guarding it. And it really requires some second-order thinking in order to convince and create a value proposition where you're essentially telling them that you're going to be better off by giving up your data in exchange for better, more incentivized versions of everybody's data. But you can no longer compete on your data moat. You need to compete on real products and real value. But you'll have the data that's able to help you create those real products and real value. So it's a evolving thesis and a challenging way to actually incentivize, or a challenging way to get people there. But you need to think about it if you're going to be attacking people's data and people's data moats. And last, capital is expensive. I come from investment banking. We spend essentially 95% of our time just figuring out how to manipulate capital, how to get capital in different ways, how to get it cheapest, how to incentivize the people who have cheap capital to give us their cheap capital. And if we just spent half as much time thinking about ways that we didn't need as much capital, I think we'd be in an amazing place. And finally, just because I've been in the market very heavily for the last kind of 6-8 months, some of the things that we're seeing, because we go to a lot of conferences, we get pitched a lot, and there's some definitely evolving trends that we've seen. Raising cycles are being stretched out. And it's less of I have a white paper and now I'm raising $100 million. That sort of model is dead from 2017, the 2 dudes in a white paper, or 2 ladies in a white paper. And it's really seed products. Raise a little bit of equity to actually flesh out your product, get some MVPs out there, get a little bit of institutional adoption, get your token live so you can prove utility, because that's huge in the evolving regulatory world, and then go for the token raise down the line. The SEC utility tokens, which is a word I made up, that is a combination of, it's a designed utility token, but people are skittish, and so they wrap it in a Reg D wrapper, or they wrap it in something that protects them from securities law. But for instance, our fund, so we run on a utility token. We did a full analysis of what would happen if our utility token was considered a security token, and it's a nightmare. The transfer restrictions, everybody you send it to needs to acknowledge that they know the transfer restrictions. You can't use certain exchanges because you don't know where it's going to be on-sold to, and securities law might come back and say, oh, you took an act in furtherance of a trade that ended up with your token back in this jurisdiction. So I'm all in on security tokens and being regulatorily compliant, but if you're relying on heavy flow and network effects of your utility token, wrapping it in a securities wrapper could destroy that value. So be very careful about undertaking that. Concept of proved utility, like our friends at Windminer and the TripKey guys as well. The concept of building out your platform to the point where you can actually use the platform to generate tokens is a huge marker towards proving utility of your tokens. If it's an early sale of a token towards a platform that might exist in the future, much more challenging. And it's becoming that you can't just have an area of regulatory requirement that you know and like. You can't just operate in the United States or just operate in Canada. You really need to start becoming kind of a bit of an aficionado of the evolving regulatory regimes in the world. Crypto, by definition, makes it much harder to be captured within a regulatory regime because it reduces these frictions so much that it makes it a lot easier to operate a global platform. So I would encourage everybody to explore that global evolving landscape and consider if there's ways to combine regulatory regimes. There's certain ones that are, so there's 2 sort of angles to this. There's certain regulatory regimes that are thoughtful and progressive. Malta, Singapore, Gibraltar are all doing very good, interesting things. And there's certain regulatory regimes that are sort of the wild, wild west, where they just don't give a shit what you do. And so you can get to the same point somewhat in both of them, but one actually offers you kind of certainty, and one is just a free playground that may change at some point. So don't always take the cheapest, fastest one. Find a thoughtful one that works actually with you and has kind of a light touch, but a thoughtful, understanding approach of it. And finally, more and more thought is being put into how to exit these things. If you have a utility token, you're holding the same vehicle as somebody who's actually using the platform. And that's something that's never happened before, where the investor and the actual user are using the exact same vehicle with the exact same rules, the exact same ownership requirements, the exact same governance structure, all of that. It's one of the most fascinating things about blockchain, but it's very, very challenging to think about from an ownership, investor, VC perspective, and how you actually do it. So one of the ways that we're thinking about is how do we exit our position to an actual scale user of the platform, rather than going into public market or going to Binance and dumping our million tokens, or even potentially finding a family office who would be interested in a more de-risked investment. We're looking for particularly something like Velocia. When they're talking to big OEMs or talking to big cities or municipalities, is there an opportunity for us to exit our investment to that city or to that OEM in order to actually exit our investment into the platform and really kind of supercharge it, or even do part ways so they start using it, our investment goes up? There's a lot of economic incentive things that are built into utility tokens and built into tokens in general that are really becoming to the forefront now of the thought process. And finally, like, the bear market of 2018, in my opinion, is the best thing that could have happened to crypto. The market about a year ago was honestly a bit gross. There was a lot of people who made way too much money way too quickly. Every conversation was about price. It was about how quickly can I get listed, when is the Lambo coming, when moon, all of that stuff that's super annoying. And so the bear market has really pulled all of that heat away. Everybody has kind of gone home, put some headphones in, and started building shit, and it's amazing. The amount of cool stuff that's under production right now is incredible, and I love the fact that it really has sort of taken the hype cycle off, and people are just building cool stuff. So I encourage all of you, everybody who is pitching today, you guys are all doing a wonderful job. Give it time, it will get there. You guys are all building amazing things, and happy to take questions. This is me and my partner there. Thanks very much, guys.
Do we have any questions for Alex? Yes.
Hi, Yair. I'm the founder of InView. What's your profile for investments?
So our profile for companies that we look at, we want a company that is thoughtful about how they're using blockchain, that has product market fit with their actual founders, of somebody who's done something in the past. We want somebody who can actually benefit from the additional leverage that an interoperable world gives you on your blockchain side. And we want somebody who we can kind of map onto that value chain in some way. We also want an investment vehicle that makes sense given where we are in the landscape. So we don't play just in tokens. We do equity, we do convertible debt, we do equity with token kickers. We want the type of investment that we can really work with you, get involved. We're very active with our portfolio companies. There's a few of them floating around here. And so we take advisory board positions, board of directors. And so we really want a company that's at the stage that is looking for a partner who can use productive, interesting, thoughtful capital and can really be thoughtful in what they're actually creating and putting into the world. No problem. Any other questions?
Any other questions for Alex? Yep.
Hi, thanks very much for your talk, mate. Really interesting. I completely agree in the trust sort of dynamic and shooting for the trust, unitary trust sort of setup. Is there any, because I know there's some people working on web of trust type technologies, is there any projects that you've seen that particularly interest you in that sort of trust management?
Definitely, and that's a super interesting point. So the question was about web of trust, and it's essentially a way to, one of the biggest challenges in crypto right now, as I'm sure all of you are very familiar with, is losing your private key and the risk of absolute total loss. And just like an entrepreneur isn't set up to deal with total loss, a company isn't set up to deal with the total loss with no recovery systems. So the web of trust is essentially nailing down trusted people in your network who can vouch for you and regenerate your private key. So it's essentially, instead of a mnemonic, it's people. And it's a super interesting concept. There's two projects I know that are tackling it right now. One's called Tensorum out of Australia and Singapore, I think. I'll send you their contact info after. And the other one is actually one of our portfolio companies called Vault Wallet. that they're really focusing on the highest user experience for a wallet that can integrate directly within platforms. So the Windminer, Velocia, or ClanPlay, one of our other companies, they want a wallet that sits within their platform that allows the decentralized logic that makes all of this stuff wonderful. But if a client loses their phone, they don't want to just say, oh, well, sorry, the whole thing failed now, I guess. You're screwed. It needs to have that last mile of user experience where it replicates or it gets to the point where you don't care that you're using blockchain. You just know that you can do something now that you couldn't do before. And that gap is really what's going to get the mass adoption. And something like a Web of Trust, there's other ways that are trying to solve that gap as well, but something like the Web of Trust is a really cool way to sort of move the needle that way as well. Anything else? Great. Well, thanks very much, guys. I'll be around all day,
Alex.
so happy to talk through any of it.
Thank you, Alex.